Hi there. Welcome to Berman's Call. We're here to take your questions on both stocks and ETFs. Today, you can reach us toll free at 1-855-326-6266, or you can email us at bermanscall@bnnbloomberg.ca. Of course, Larry Berman joining us now to chat. It's good to see you.
Good to see you remotely this time,
Yes,
Lindsay.
remotely this time, maybe not so next time, but let's get into it because there's a lot to go over, a lot of changes as 2026 seems to be a year of changes every week, it seems. Let's start with the new tariffs that Donald Trump is saying he's imposing on the world. These global tariffs, at first they were 10%, now he's saying they're going to be 15%. What do you make of that? How's that affecting the markets?
Well, it's more of the same in terms of Donald Trump's style of pivoting and using tariffs as a negotiation tool. None of this should be a surprise to the markets. The Supreme Court ruling was a little bit of a surprise, and we got a pop on Friday when that came out. But the reality is Trump was always going to try all these other avenues for implementing tariffs if SCOTUS did not vote in his favor, which they did. So now they're going to implement different types of tariffs. And frankly, the market shouldn't care too much about it. And whether it's 10 or 15, like ultimately, to me, it's more status quo. So the noise of the day is probably somewhat related to that. But anxiety over Nvidia's earnings this week could be it, although Nvidia, last time I looked, was up slightly, while just about everything else in tech was down. So from that perspective, it tells you that the market's, I think, pretty excited about what Nvidia might deliver this week.
I do want to talk about Nvidia in a moment, but just staying with the White House and the kind of geopolitical aspects that we're watching for. We've got the State of the Union address. That's happening tomorrow, I believe. What are you watching for there?
Most interesting thing for me is what he says about Iran. You might remember, well, you may not remember, because I think that during that speech you may not have been born yet, but sometime in the 80s, one of the US presidents, I think it was Bush 1, called the axis of evil. And he's very specifically said North Korea, Iran, and I can't remember who the other one was. But So the world understands, I think, most of the world, that there's some sort of regime change coming in Iran. We hope it's peaceful, but by the looks of it, it may not be. And I think that matters more for the market and what he says tomorrow, because all eyes and ears in the world are going to be on that speech tomorrow. So if he ramps up the rhetoric around be clear, if you guys don't cooperate here, it's going to be a bad outcome. With the military buildup in the Persian Gulf right now, that's probably what the markets are more nervous about right now.
There's so much rhetoric, though, that comes out of the White House these days, so much talk. It's hard to know what to put stock into and what to just let go by, right?
Well, it's just a person of Jewish faith who believes strongly in Israel's right to exist. When you have a country in the world that has an official policy of wiping Israel off the map, there's not a version of the world where they get access to nuclear weapons. And so that really is the discussion here. What happened in Israel on October 7th, a few years back, to me was a 9/11 moment. I said it on BNN the next Monday show, that this wasn't going to end in Gaza until Hamas is eradicated and there's leadership change in Iran. And I don't see it any other different at this point.
Okay, I said we were going to talk about Nvidia, so we're going to switch gears, talk about that a little bit too. There's these highly anticipated quarterly results coming out this week. What are you watching for there?
Well, Jensen's been a master at saying the right thing during the earnings call and everything else. But when you look at Nvidia and you look at maybe a 5-year picture of it, if it's possible to put that up for perspective, it's really been a category leader. But at times, for the period of about a year, it went sideways. So we had a massive run up. It went sideways in 24 and into early 25. We had another run up in 25 post tariffs, and it's gone sideways basically ever since. reaching 190 about a year ago. So from end to end, you get these short periods where there's rapid markups. And the question is he going to be able to say enough, given everything we know about all the CapEx spend on chips and GPUs that have already been announced, to make it even better than that? Because the market typically needs better news than what's already known for it to get a leg up. And if Nvidia can't do that for this market with all the concerns around AI, the odds are that we break 5% lower on an S&P, maybe 10% lower, versus continuing the rally at this point. So to me, that's the critical event of the week. As important as geopolitics are and tariffs and what POTUS says tomorrow night, I think Nvidia, from the market standpoint, might be more important in terms of continuing this AI-dominated bull market.
Okay, we're going to take a quick break. Coming up next, though, we'll get to your phone calls and emails. So here's the number again. This is how you can reach us, and there's still time to give us a call with your questions on ETFs and large cap stocks. We'll be back in a moment. Welcome back to Berman's Call here, of course, with Larry Berman. We're going to go to an inbox question, Larry. This one comes from Brian, and it reads, how does Vanguard S&P 500 Index ETF look over the next 10 years? Putting money away for my daughter's university fund. What do you think?
So when you look at the last 100 years of returns all around the world, the S&P 500 is the leader by far, more than any other country, more than here in Canada. So I think it's a winner measured in the long run. Now, having said that, what we do know about times of returns and forward-based returns, because what was in the rearview mirror is not the future, given the valuation of markets today, I can say with a high degree of confidence that the average return for the S&P 500 over the next 10 years is going to be less than it was over the last 10 years. Right? So if you go back to 2015 and say where we are today, you could see the markets run up huge. But we went from, in 2015, a multiple of 16 or 17 times earnings to today a multiple of 24 or 25 times earnings. If the multiple is sustained, then we could have a similar type return, but I doubt that very much. And at some point, we have a valuation correction. Best rule of thumb is periodically we get these 5 to 10% corrections in markets, and sometimes they're more than that. During those periods of correction is the time to put money in markets. So if you've got a plan to allocate annually over the next decade to VFV, again, great vehicle to do it with, I would wait for those dips, 5 to 10%, and that's when you put your money in. That will increase your average 10-year long-run return. So it's a form of taking an active approach to dollar cost indexing. What we can rely on is the market will have corrections all the time. We just don't know in advance when they will be. So that's a good planning strategy for a lot of people who are looking to dollar cost average.
Okay, we're going to go to the phone lines now. Carmelino from Montreal is calling in with a question. Hi there. What's your question?
Hi, Lindsay. Hi, Larry. Thanks for taking my call. I'm looking for an ETF, if you could recommend one that holds emerging markets.
Okay. Thank you for that. Emerging markets ETF.
Yeah, lots of choices. Most of the ones in Canada are index linked to the MSCI Emerging Market Index. Vanguard has one, and BMO has one, et cetera, and iShares. So if you want an active emerging markets, the one that I recommended a few years ago was one that trades in New York. And by and large, you're getting foreign currency exposure anyway, so I wouldn't be too worried about the foreign exchange exposure. Freedom is the ETF. FRDM is the ticker. And that ETF gives you exposure to emerging markets, but the weighting scheme is weighted towards better government governance, child labor laws, anything you can think of that's more socially responsible is not the right way to put it, but more freedoms. So when you have more personal liberty and freedom in an emerging market, so you're going to favor India over China for that matter, and so forth. And so the weighting scheme's geared towards that. That's been a stalwart outperformer. I think measured in the next decade, it will be an outperformer. And I really, really like it and its construction. FRDM trades in New York.
FRDM. Okay, back to the phone lines. Bob is calling in from Hamilton with a question. Hi there. What's your question?
Good afternoon, Larry. I just want to ask you a question. I'm a senior and I want to invest some money for a dividend. Which would you prefer, ZWU or ZWE? Thank you.
Okay, thank you.
Right, and so I love these questions, and the answer is why not both of them? So one gives you exposure to high dividend covered calls in Europe. Nothing wrong with that at the moment. And the other one is utilities in North America, predominantly in Canada. Nothing wrong with that at the moment. So I would say both. You know, if you're holding a gun to my head and say which one now is better for the next year, 5 years, or 10 years, I would argue that if you're in a taxable account, go with the one in Canada. You're going to get better tax treatment. If you're in a registered account, go with the European one, because I think there's more growth potential there. And it really depends on what your other needs are beyond, one of those two ETFs. Hopefully that gives you some thoughts.
All right, back to the phone lines. Phil calling in from Vernon, BC with a question. Hi, Phil.
Hi, how you doing?
Good, thank you.
Larry, I was just wondering, in light of the recent pullback with the tech stocks and the AI scare, I have an HHIS ETF I've been averaging down on. Should I be doing that? And how long do you think this dip might possibly last? Just wanted your opinion on that ETF.
Yeah,
Thanks.
great question. So what they teach us in chart school is never predict time and price in the same forecast. And I'm being flippant about that because I wish I knew, because if I did, I'd have all the money in the world. But I suspect there's, on the software side, where we had a big crush with Microsoft and a lot of the software names, I think that part of the big tech is closer to better value. I think there's still some AI names like Nvidia, but more recently Google, that are on the higher end of where they might end up settling. So it's a mix mash. I don't know that there's one. HHIS, has all of them in it. And so I think you're going to still get some grinding and rotation here over the next number of months. And what really changes that is some sort of material change on policy. In terms of we're not worried about tariffs anymore. There's more potential economic growth coming. But I think we've priced in an awful lot of good news in AI and tech in general, and we're just going to go through this consolidation period. So months to maybe into 2027, because post-midterm elections, depending on how those go, there's a good case to be made for a harder economic downturn at this point. This calendar year, we've got broad support. We're seeing the average stock in the S&P 500 perform really well. It's just not the average tech stock that's performing really well this year.
Okay, an email question now from Lana, and this one reads, on the last episode, you said, quote, if we are closer to the end of the business cycle, what is your definition of the business cycle and how many other cycles are there? For example, I've heard the credit cycle, commodity cycle, et cetera. Thank you. So what did you mean by that, Larry?
Well, the business cycle is a pretty standard definition. You can look it up on Google, but it's typically tied into credit expansion and contraction of the economy. But if you think about GDP, we've got years and years and years and quarters and quarters and quarters of positive growth. So that's the business cycle. And when GDP contracts, it's the end of the cycle. So as the economy goes up and down, that's the business cycle. Typically tied into credit, but there's presidential cycles. So for example, if you go back in history and look at the US presidential cycle, we know when the election is. It's every 4 years. It's not like in Canada where there's a lot of variability on when we vote and how we vote. Most countries in the world don't have that fixed cycle. So the US has a presidential cycle. We know that depending on the makeup of Congress and the White House, There's certain spending that happens in certain periods to get reelected. And so there's market patterns where some years of the 4-year presidential cycle are better for markets than others. There's a commodity cycle, typically related to the business cycle, i.e. economic contraction, more demand for commodities as we're building more and more things. Again, it's tied in and related to the business cycle. So if you think about the business cycle being way up here and some of these other factors like credit and commodities being part of that overall business cycle, hopefully that gives you some of my deeper thoughts on it.
Okay, next up, a question from Evan. This is an email. It reads, ZPay has been in a bit of a downtrend, but with sentiment seemingly turning away from U.S. markets to international markets, does Larry think that ZPay would be a good hold at this time due to the downside protection that the ETF offers?
So it's got downside protection in the sense that there's puts being written to acquire stocks. But you are also short volatility in that. And when the markets go down, typically they go down a little bit less or somewhat less. But it's not protection in the terms of some of these buffer ETFs that give you, that are long volatility and give you protection on the way down. So while I love the strategy for income-focused investors, you still want to wait for a correction to add new money to it. But if after that correction you're wildly bullish on the long run, this is not a fund that's going to generate long-term capital gains for you. This is an income-oriented fund. So it's defensive in nature, and it's ideal for people who are a little bit more defensive and seeking higher tax-efficient income. That's what ZPay is for. And so averaging into it, if that's the kind of investor and need you have, it doesn't really matter what the markets are ultimately going to do. It's a good vehicle to buy into dips and average in, for sure.
Got time for one last question. This is from Ernie. It reads, hi, Larry. Are you familiar with Harvest Portfolios Group? They've enhanced high-income shares that have a covered call. I'm looking for monthly income. What do you think?
Yeah, so the Harvest Group has been great. HHIS was an example of one of their funds. So they've started doing covered calls on individual stocks and et cetera. So you got to be careful because a lot of what you're getting out of those is eating into the capital appreciation compared to buying the underlying on an outright basis. But if you're a tax-efficient income seeker, a lot of these high-yielding products are very, very good for taxable investors. There's not a material benefit within a registered account for these type of securities.
Okay, we're going to take a quick break. Coming up next, though, is today's educational segment, so stay with us.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. We are here with Larry Berman, and it's time for Larry's educational segment. So, Larry, take it away.
Nvidia, and I want to get the pronunciation right because it's a little pet peeve for me. It's Nvidia. It's not Nvidia. Anyways, back in 2020, late 22, there were some rumors about Microsoft taking a big stake, which were finally confirmed in January of 2023. And so I put together a chart here saying how important Nvidia is to the market. So this is the total return of Nvidia stock relative to the S&P 500 and to the technology sector overall. So if you look at the average annual return in the last couple of years of the tech sector, it's around 30%. The S&P 500 around 20% since that early January period in 2023. And for Nvidia, over 100%, about 110%. So you have a multiple influence of Nvidia. It's not a new story. Everybody knows that. And I'm really long-term, very, very bullish. We're very early in the AI game. Barry Ritholtz did an interview with a professor this weekend. So if you listen to Masters in Business, highly encouraged to listen to Barry's interview this week with a professor, and her name escapes me. But she's talking about, again, why crypto and why AI is pricing in, some bad things in terms of potential growth, potential earnings, impacts in lots of different areas. Again, one person's opinion. But there's this general anti-AI, not anti-AI, but concern about AI and the growth rates perking in. And that's why I think what Nvidia says this week is actually far more important than what Donald Trump says in the State of the Union. Now, make no mistake, measured in decades, I think both the AI impact on the world and how the U.S. governs itself globally matter a whole lot. But this week, I think it's a bit more important what Nvidia says than what comes out of the State of the Union address. When we look at the State of the Union, Trump is going to say, this is the best economy ever. He said it in recent weeks in many, many speeches. The reality is it's one of the worst economies ever. Because in the U.S. last year in 2025, they averaged about 20,000 jobs a month. That is the worst employment growth that we've seen in decades in any presidential regime. So AI is starting to have an impact on that. Definitely a lot of dislocations around employment related to COVID, so that's a factor too. When we look at GDP, initially the expectation for GDP was going to be higher. We saw some revisions in the last few weeks. GDP now for the US last year is around 2.2%. When you look at this last graphic here, this is the deficit as a percentage of nominal GDP. You can see during recessions, during COVID, during the GFC in the early part of the 2000s, where the recession percentage as a negative, as a percentage of GDP goes up. And so the reality is here that we are in an environment where we're running a deficit, 5, 6, 7% of GDP the last couple of years, and we're getting 2% economic growth. Folks, that is a very structurally weak economy. But this has been the case for the better part of 25 years now, where there's been this structural deficit in the US, and we've averaged 2 or 3% growth. And what it means is the debt keeps building up and building up and building up. And one day it'll matter. And what kills the whole thing with all the debt is inflation. And AI is very, very disinflationary. So that dynamic about governments spending our money poorly and the disinflationary backdrop of technology is a very interesting debate in the coming years. But I think this week it's more about technology in general than it is about governments and deficits.
Okay, we'll leave it there. Larry, thanks for that. If you'd like to follow Larry online, you've got options from YouTube to LinkedIn. You can follow him there. And that's it for today's show. Thanks for watching.